Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
G'day, welcome to the Australian Property Podcast. This is our weekly 2 cent segment with me, Pete Wargent from Alan Wargent, Property Buyers, and I'm here with Chris Bates from Flint Group. Chris, how's things?
Life's good, Pete. I've had about 3 weeks being off sick. People on this podcast will probably hear about it every week. I'm not sounding as nasally as I had the last few weeks, but today's a good day. But who knows what the kids are going to bring home from kindy on a wet day today. It's really good. We might move into our new office on Monday, so the team's all super excited for that, which is going to be great. And just battling on through this winter. And sickness is my challenge.
Did you get a good deal on the office space? Whereabouts are you? North Sydney somewhere?
Yeah, straight opposite the station at North Sydney. Yeah, I mean, there's 20% vacancy rate. So, we saw a lot of spaces. And, not only can you get the C's and the B grade properties at a good price, you can actually get the A grade ones. So new builds and, things that probably would sell rent very easily in upturns. But in this current market, they're struggling to get people to commit to longer leases. And so you can get huge incentives, 35, 40, up to 50, 60% potentially. So not great for a landlord, but good if you're trying to rent a space at the moment.
It is. I stayed down at McMahon's Point about a year or so ago, just at an Airbnb. I was down there for a month and I spent a lot of time in North Sydney. Great. Spent loads of good coffee shops. Caught up a good friend of mine, David, who's probably tuning in, just around North Sydney. Great place to work, and it's we used to call it the dark side when I lived in the eastern suburbs, but there's everything you need there, right on the water as well if you get down that way. So pretty envious of the new space. I'm looking forward to dropping in later in the year.
Well, I mean, the metro, which is more of a broader conversation, that's only months away. These big infrastructure projects that just you hear about the tunnels, you see the news, you see the hoardings up in the stations getting built, but that thing's going to be live sometime this year. And that's a game changer for how Sydney's going to flow, basically. I mean, you can go to any of the work hubs basically on that metro, particularly once the Metro West goes live, once Parramatta, like around 2030-ish. And then obviously you've got the airport out in Western Sydney as well. And there's another line out there. But that metro, if anyone's lived over in, or at least traveled overseas and you use subway systems in, global super cities, you just see how much easier it is to get around and, not having to check timetables, just rock up and there's always the next tube or subway available. So I think the metro is really, the current metro from, I think from Chatswood up to the Hills area. I'm not exactly sure the last stop, but, that's been great, but it's finished there. It hasn't got all the way into the city and, excited to see that go live in a few months.
These things always work best when you can just rock up and you don't need to check, is the next train in 15 minutes or half an hour? Definitely, I remember at Bondi Junction, you never had to plan. You just get on, just arrive at the station and get on the next train and within 5 minutes. That if we can get Sydney working like that, then there's a lot less incentive for people to drive in, I suppose. I think on the health theme, I've just been, I've had my annual health checkup this week. I've got to go and do a load of cholesterol tests and blood tests on Monday. So I've got to do a 12-hour fast with no caffeine. So I've got a gallon of coffee next to me today before I have to go on a 12-hour fast. But it's something I've been thinking a bit about. I've had my skin cancer check. It's I guess like always, you're trying to balance up. We talk a lot on property podcasts about financial health, but you've also got your physical health, your mental health, and also just having some time to enjoy life. And it's trying to get the balance between those four things. I guess that's always the challenge. It's been something that's taking up a bit of my thought processes at the moment. But let's get on to the property story, shall we? So what we got this week? Savage repricing for interest rates. So it was largely US inflation figures that have been spooking the horses a little bit, and also renewed conflict in the Middle East not helping matters. Second story, Australia world leaders in interest rate pain. I think for a couple of reasons. We've got a lot of variable rate mortgage debt. I saw last month that only about 1% of borrowers are on fixed rates, new mortgages now, so that's kind of gone. So the variable rates plus a relatively high level of household debt, because we don't have so much social housing in Australia, means that interest rates are bitten much harder here than almost anywhere else in the world, actually. And you're starting to see that in the economy, starting to bite a little bit. And then third story, wealthy property investors return to the big city. That was a story, James Kirby in the Australian. We'll take a look at some of the latest trends, where people are buying, where people are selling, because some investors are definitely tapping out now. So let's start with the inflation and I guess interest rate story, Chris. So core inflation in the US was 0.4% in March. Market expected 0.3. It's funny sometimes with this stuff, like you think about what's the difference between something that rounds to 0.4 or 0.3 and it's like the end of the world. But it is now the third strong month in a row, and definitely the Fed won't be in any rush to cut interest rates. It's quite funny to watch this stuff because we've got an upcoming US election. A lot of the US economists, they're really advocates for the government, and they really don't want to talk about these latest inflation figures. They were very quick 6 months ago to declare the victory was won, but now they've gone mysteriously quiet. And I think if you look around the traps, Canada, New Zealand, UK, we've got the disinflationary trend is still intact, but it's just not coming down quite as quickly as markets might have expected or would have wanted. And we measure inflation slightly differently. In Australia, we don't have owner equivalent rent, I suppose, like in the US. And our pipeline indicator that AMP runs doesn't seem to show up the same issues. But even still, we're still a bit of a way to go in Australia too.
Yeah, I think that's the story, isn't it? That, when you looked at the US numbers, you thought, well, is that an indication of how inflation's going to drop off here? It dropped very fast. It came down, and, they did call it, right? We've put the genie back in the bottle, right? That's even prior to this whole increases in interest rates and this inflation outburst over the last few years, that was always like will inflation ever, kick off, right? And it's really hard to get it when it does go wrong, and it goes wrong hard. And I think that's been interesting, right? That's 3 months. I think that is playing into, our buyers' minds a little bit. Like, just where interest rates are going has a huge impact on sentiment, right? Like, if you believe the interest rates are going to stay quite high, for a good 2, 3, 4 years, I don't think there's urgency to buy, right? Absolutely, which you mentioned there, Pete, investors bailing, which we'll talk about. You will see a bit more of that. You will see lots of homeowners under stress. And, as a renting versus buying, well, you go, it's probably a better bet to rent if I can find a place versus buying if interest rates are going to stay high for a few more years. But if you believe that interest rates are definitely on the top end and they're coming down and they're going to come down over the next few years, I really want to get ahead of that. I don't want to be buying as interest rates are getting cut, because it's a double whammy. Yes, I've got more borrowing capacity, but so does my competition. And so does my competition have more confidence because they know their mortgages are getting cheaper, not more expensive. And then there's also a bit of intergenerational wealth, like that, unfortunately, sometimes you can't compete with. And if that starts getting passed down because the parents and the grandparents are wanting to get their kids and grandkids into the market, so I think that's what's playing on the market. Look, I think there's always the myth of supply. I think that, the turnover rate's been dropping for years. The number of sales is even though our dwellings are going up, our number of sales, if are falling, as a percentage. And I think in the housing market in particular, not so much the unit market where a lot of investors have been selling, but the housing market, people are stuck in homes. And I just can't see this. There was a bit of an influx of supply coming on at the start of the year. But I think the last few weeks have been pretty dire with Easter and Anzac Day. And then we're going to come into, May, etc. So the supply might come. But so I just think this is why this story is interesting, Pete, is because, this view of where inflation and where interest rates are going is having a huge impact on sentiment, but not just buyers. Everyone just thinks, market must tank because buyers are going to buy. Well, what is the impact on sellers? Well, sellers may go, well, do I really want to upgrade right now if rates are going to stay high? So supply tightens up. And so, there's always a supply and demand balance.
A couple of bit of anecdotes for you. So one thing I've heard is recruiters in Sydney are getting a bit twitchy. Hiring plans are falling away. Recruitment difficulty, that was very tough. About 75% of firms at one stage were reporting difficulty in finding staff. That was back in the peak of the shortage, 2021, 22. Well, that's dropped right off a cliff. And just, anecdotally, recruiters are being told you need to step up your game, or you might be taking a long walk off a short plank. So that's one thing I've just heard around the traps. Hiring intentions dropping away. We're recording this on the day of the latest unemployment figures, so who knows what they will show up. But I think just generally, there's definitely a slowdown in the economy happening. Another thing is that some of the groups like Domain and SQM run these indices of distressed sales, and they're very, very low actually, and they've been falling again. But we have seen in recent weeks just a few more indications of people selling properties that were bought 18 months ago, 24 months ago. And they might not be distressed sales in the conventional sense, but they could easily be often investors who bought with the expectation that interest rates would peak at a much lower level than they have. And I think a lot of people are probably finding, hey, if interest rates are going to stay higher for longer, if it's 3 months, so be it, 6 months even. But if you look at market pricing now, the first interest rate cut for Australia has been pushed all the way out till 2025, possibly even the second quarter of 2025. And I think there's more people going to look at that and say, okay, if that's the way things are going, then these cash flow numbers aren't so comfortable for me and I might just tap out. So, there's a bit of that going on. I think just generally a steady sort of disinflationary trend. I think the inflation figures for Australia, which aren't going to move exactly in line with other countries, forecast for next week, CBA has 0.7% for Q1, which would take inflation down to 3.4. So a little bit higher for the core numbers. So we're moving in the right direction, but just that last leg of the journey might prove to be the trickiest.
Yeah, and I do think there's a bunch of investors looking to sell. Particularly, you can see that, listings on apartments. Houses are still really tight, but the attack on land tax is a really interesting one. I think that is weighing the American land tax bill in this week, and it doubled in Victoria for a house down there, and that's a pretty big. Once you add in on top of interest rates, and the rents down there haven't been as strong in terms of growth, and you go, well, my negative cash flow is now X, and it was Y, and and my mortgage has gone up, and well, I can sell it, but I'm not going to sell it for a lot, but I can sell it, hasn't gone down in price, it's still up. Should I just get rid of it? And I think that's weighing on investors, particularly in Victoria, where they've gone hard on land tax, and that's not going to be great for long-term rental supply. If you want to rent a house, I think you're going to start seeing more and more people sell them to owner-occupiers, which is great. But for first-home buyers and people looking to own a place, I think that's absolutely playing. Look, I think when we've seen quite a few upgraders come into the market, so they're in a smaller house, they want to get into a bigger house, or they're in an apartment, they want to get into the housing market. They're doing well financially, so they've got great borrowing capacity, and they're able to make that jump and that leap. Whether they've built equity or whether their incomes have gone up or they've got intergenerational wealth coming. But they're also doing that with the anticipation that, if they don't do it now, they're going to regret it, right? So that sort of fear of missing out. Well, if they think that rates aren't going to go down, well, then they won't list their apartment or their house. And you'll see this sort of Mexican standoff happen again, and the markets will freeze up. And, what people want is that sort of confidence and certainty. That's when they transact. They don't transact when there's this unknown. And that's what our agents are really hurting right now, right? They're just really hurting for quality listings. And that they're obviously harder, the better the quality of the property, the easier it is to sell. And, yes, they're getting listings, but sometimes they're not the best rows. They're people who are just, really struggling to get out. They may be over leveraged in downturns into poorer assets. And they're like, well, I don't really love the place anyway. If I can just get out and rent, that's better, because this is now forever home. This was always a stepping stone. And maybe we're better with money in the bank and trying to enter when, it's a better time for us to buy. So, yeah, that's what we're seeing. I mean, it's an interesting time. Should we go on to story 2, Pete? We're already 15 minutes in.
Oh, blow. Yeah, the time gets away from us as always. Yeah, big life decisions. So second story, rate rises have hit Australia harder. So the IMF, International Monetary Fund, has released new research on the effects of monetary policy on housing markets. Basically, they showed that, as we kind of knew, Aussies are more sensitive to interest rate changes than almost anywhere else in the world. A couple of reasons. Even though we did have a period there where a lot of people were on fixed rate mortgages, now is kind of under a fifth of the market. So most people are on variable rates. We also, unlike some other countries, the government doesn't really own much of the housing stock at all in Australia. So household debt levels are higher. So yes, government debt in Australia might be comparatively low, but household debt is somewhat higher. I think if you look around the world, there are some countries with lower shares of fixed rate mortgages, like I guess generally countries maybe with different bond markets like South Africa or Chile, but we're near enough the bottom of the pile, really. In so other countries like the US, like overwhelmingly people would be on a fixed rate mortgage. So as it impacts the housing market, if you look at the change in outstanding mortgage rates across the market since 2021, brilliant charts from Antipodes and Macro, which is Justin Fabo. Basically, the US has seen almost no change, like maybe a 25 basis points increase across the market. Australia is 300 basis points. New Zealand, yes, more people do use fixed rate mortgages there, but they're generally short-term fixed rates, and all of those have reset as well. So really, except for maybe Norway as an outlier, Australia and New Zealand have been impacted harder than anywhere else. If you look at Canada, UK, Sweden, US, much less impacted. I'm coming around to the view, Chris, that interest rates in Australia could easily fall before they do in the US, but partly because of exactly this, that the changes in interest rates here have a much swifter impact, and they hit households much harder, much more quickly. I think that we still do have some inflationary pressures around. I think if you look at particularly the rental report from Domain this week, 5% increase for houses in the March quarter across the capital cities, and that's 17% over the year. So that's an issue, but I'm not sure interest rates are going to help there anyway. But 6% of the inflation basket in Australia is rent. It's not like in the US where shelter has been the main issue. And I think CoreLogic also showed construction cost inflation's at a 17-year low. So we do still have some inflationary issues, but it's I think interest rates have had a much harder impact here.
Yeah, and I mean, I guess you'd be a bit upset if you when interest rates, people could lock in 30-year fixed rates in the US. They were sort of, I wish we had that in Australia, people were saying, right? Because you would love to have locked in 2%. But, my argument back then was, well, for them to get in control of inflation, which they have done in fairness, they're lower inflation rate than us. But, if they've only had a half a basis point increase in the overall interest costs as the economy, where we've had a 300 basis points, it's got to show that the pain they can, slow down the economy is so much faster, right? So actually interest rates and monetary policy actually works. Well, does that actually work in America? And that's a big tool that they haven't been able to use. What's your take on that, Peter? They just got a bit lucky here and they've been able to get inflation under control because it hasn't been interest rates that have driven that.
I think a bit of it's a base effect thing. I think if you actually look, now this is what a lot of people who don't follow economics as closely would say. It's like, hang on a sec, if I go to eat out, if I go down to Noosa Civic straight after this, which I will, it will cost us $100 to eat out. It wouldn't have cost that 4 years ago. So where's this in the inflation numbers? If I renew an insurance policy, that's up 50%. If I go to fill up the car, that's up 50%. It's like we've added a zero onto almost everything. So yeah, I think a big part of this story is whether you're looking at the absolute increase in prices over the past 4 years versus the base effect year on year. So what you'll probably see over the next 6 months is countries like the UK, where inflation went crazy. It was like 11%. It will probably fall faster on the way down now as energy prices normalize, and it'll probably go to zero. But even then, if you look cumulatively over the 4 years, everything's got more expensive. So yeah, there is that. I think there's been some other changes, but I think, shelter is the big one for the US that hasn't really slowed down yet. A lot of these countries are not helping issues with running record immigration programs. You can count Canada, UK, Australia, USA with a lot of illegal migration as well. That's not really helping with the aggregate demand. But there's other levers as well, of course. One of the interesting things in Australia is tax payments as a share of disposable income. Well, that's back above 20% now. The bracket creep has really reduced people's incomes as a percentage of, so to rephrase that, tax payments as a percentage of disposable income. If you went back to 2010, it was about 13 or 14%. Now it's 20. So you would have seen that as a mortgage broker, that there are other levers that are pulling some money out of the economy and away from consumers. So it's not all about monetary policy. There's government stimulus as well. But yeah, I think, a lot of this stuff is like the year-on-year numbers are one thing, but you've got to look at the absolute increase in prices over 4 years as well.
Do you think that it becomes a bit of a tailwind, though, as if we do get inflation under control, that we can then cut rate, more strongly than other countries around the world, and then potentially that'll give us a bit more capacity to spend money, and then that'll boost our economic growth? Or do you think that, higher interest rates, it's a bit of a catch-22, to be honest, because, a lot of people who are, got their super funds, or, a lot of the older generation have got money sitting in a bank account and the term deposit, the shares was too risky. They'd be loving it right now, right? They've property values are good. They're getting a great return on their cash, and their super fund's doing well. And they're probably out there spending more than they ever have. So what's your take on the ability for us just to cut rates much harder if we get inflation under control and we want to stimulate economic growth?
Oh, it could be, for sure. I mean, one of the reasons I've been bullish on Australia over the years is good open economic model, high immigration, usually skilled immigration, relatively low government debt. If you look at net debt over the next decade, it's expected to be extremely low when you compare to other countries. So there's a lot of buffers there built in. I do wonder, though, that the strength of the housing market recovery, even in the face of all these interest rate hikes, I just wonder whether that could make the Reserve Bank a bit less keen or more reluctant to deliver interest rate cuts, this year, early next year, because this is just something we talk about with our buyers agents all the time. It's like, here's an anecdote for you. Went to look at a house in Norman Park in Brisbane, pretty sort of bog standard suburb, really. It was a so-so property, 80 groups through, 15 offers, bang, sold 200 over the asking price. And the conversations we're having in Brisbane anyway, and I'm sure Perth people would be having similar conversations, it's like, if that's what's happening now, what is going to happen if interest rates cut? If interest rates are cut, if APRA lowers the buffer, tax cuts from 1 July, we're going to be in some kind of frenzy period. And I'm not sure that's healthy either. So I would say yes, but with a caveat that I'm pretty sure the policymakers don't want to be teeing off another frenzy. I do acknowledge that it's not the same everywhere, and it's certainly not the same up where I live on the Sunshine Coast. But in some parts of the country, in a housing shortage, you don't want to throw too much fuel onto the fire either.
Yeah, particularly the wealth effect is such a big thing in Australian economy, right? If you feel like your house is going to go up a lot in value, you're more likely to buy a new car, you're more likely to go out on holidays and spend money, right? Because you feel like your net wealth is going up, and your total, and then you're more likely to spend money. So I think that's the issue here, right? Is that we get that double tailwind. You get rate cuts. Okay, my mortgage is getting cheaper. Wow, prices are going up. Now I'm feeling wealthy, and now I'm going to go spend more money, and that really turbocharges the economy. And so I think that's. But I think you're right. Like the issue, but is housing just going to beat to its own drum? Does the government sort of said, well, we can't control that. That's just it's too big to fail. It's out of our control. Trying to control it with interest rates. And do they really care if housing affordability really gets, does that just create more wealth as a country? And do they really care about the social issues that are getting created? I don't believe they do, because these issues have been around for decades. What we've got right now is a homelessness crisis, a housing affordability crisis, a rental crisis. It goes on. And, that they just keep tweaking around the edges and doing things to support prices, ultimately, not really solving these issues with big, brave policy. I mean, Chris Minns doing stuff in New South Wales right now. That's some of the bravest action I've heard in years. And so, you can't argue that the government really cares about the issue in my book.
The Greens in Queensland are talking about the introduction of rent caps, which always a very divisive idea, because generally speaking, price caps in economics haven't been always the most successful, and they can sort of create perverse incentives, because nobody wants to cap rents when they're falling. It's only when they're going up. But it'd be interesting to see how the government manages this. The budget's coming up, and I do think we'll see a lot of talk about build to rent, probably some extra texture or detail around tax benefits for corporate investors and corporate or institutional landlords. So that'll be one way. It's a challenge for the government at the moment. It's definitely a political hot potato. And the polling actually isn't particularly good for the government at the moment either. So there's definitely some tension there. So let's wrap up with the third story, Chris. Wealthy property investors return to the big city. So yes, there's more investors we're seeing offloading, but actually a lot of investors coming back in. Commonwealth Bank report, this is from James Kirby in the Australian, shows investors returning to Sydney, Melbourne, Perth and Brisbane. There's still a fair amount of investment in regional centres, partly due to affordability. Interesting stats, the average age of a property investor is 43 with a $500,000 mortgage, and that's leading units to outperform houses in some areas, according to the AFR. Oxford Economics put out their forecasts to 2027. Significant increases for Brisbane, Sydney, pretty much everywhere, to be honest. We are seeing, I think, within those numbers, quite a lot of people looking at buying units and townhouses. Brisbane, we're seeing that, certainly in Melbourne and Sydney. But I wonder whether part of that, and this is what James talked about in the Australian, is people who can't really afford the place they want to live. So they're thinking, well, maybe if I just get a toehold in the market as a rent investor, maybe that's one of the ways, because if the average mortgage is $500,000, well, in inner city Sydney or inner city Melbourne, that's only really buying you just a rental unit, essentially.
And I think absolutely a lot of investors in the market are those investors, right? They'd love to buy a house to live in, but they can't afford to own a property in an area they want to live. So they're forced to rent, but then they've been saving hard and, doing the right thing and trying to do things for their future. And they go, well, do I need to get that money to grow, because I'm only going to get these problems are going to get worse. And so I need to buy an investment. And then they look at their borrowing capacity at interest rates and what they can afford on a cash flow. And a lot of investors, I would say, make this mistake where they just try to get a property and versus getting a good asset, and they just focus on maybe the cash flow rather than the growth prospects. And I do think that's where you start to lead to, more of the cheaper ends of markets and the outer rings of capital cities and regional and I would say sometimes properties that look great on paper, but they've got fundamental flaws with them, whether it's supply or the underlying demand for them, or even just the quickness in terms of where they buy and who they use to help them buy, and their real knowledge on what drives that local market and that part of that suburb and things like that. So, yeah, that would be my take on just the general gist with investors right now. It's definitely down the medium and to the lower end of the market. And I think ultimately that's great for people wanting to rent in these locations, because I do think you're creating more rental stock. They use potentially buying off someone, investors that outweigh owner-occupiers. So that's actually, every time a property sells, it's increasing the rental supply in those areas. And so that's great. But unfortunately, what can happen is investors also are pretty fickle. Their hold times are much shorter than owner-occupiers. And so those markets can very quickly flip the other way when all the investors bail because they go, oh, my returns aren't there. I want to take my money and run. And that'll be what I'm noticing, just the tightness in borrowing capacities and people's appetite to use all their borrowing capacity, particularly the first-time investor, because they go, well, I don't want to use everything because I do want to, buy a home in a few years. So a lot of them do try to keep a bit of borrowing capacity up their sleeve, and that also forces them to a lower price point.
Yeah, it definitely is. I've got just another anecdote for you. When he says in the Australian article, the average lending amount, $528,000, suggesting in the metropolitan districts, there's some limited choices. Obviously, this is an average number. There'll be some baby boomers with big net worths dropping bigger numbers, but we're definitely seeing for units in Brisbane around the $500,000 price point, listed, sold. There's just so much competition. I think it's a confluence of investors, first-time buyers trying to get out of the rental market, people being pushed down from higher price points, potentially with the very restrictive lending sort of buffers that are put in place at the moment, the stress testing with 300 basis points. To some degree now, I think that's really run its course, and it's just shutting people out of the market without any particular good reason. But anyway, that's another story. But yeah, I think it is generally, a lot of people have been pushed down to lower price points because of the way lending settings have gone, and of course because of interest rates as well. So yeah, it's an interesting report from CBA, some interesting trends, but it looks like a lot of inner city stuff going on statistically, and a big increase in the total value of lending, even if some investors are selling.
Yeah, I do think the set people selling versus buying is outweighed. You got 3 million plus investment properties, right? And yeah, I mean, you might get 100 or 200,000, new investors a year. I'm not exactly sure where the numbers are at, but probably somewhere around that. And if 5 or 10% of those investors bail, well, you can easily see that they're not going to be replenishing the amount of buyers entering the market. And I think if you look at CoreLogic's done a bunch of stats around this, is the percentage of sales that are ex-rental stock is at pretty good highs. It's not like so more people that are selling now are actually investors and owner occupiers compared to longer term. Ken Lardner actually made a good point on The Elephant last week around this topic, and we had a chat. There's like these mental sort of numbers that people make in their head, like you said, Peter, around 500,000 is really competitive, right? People say, I want an investment property, I'm going to spend 500. They have these lines that, and then that just pushes all the properties around that. If a great property came on, it was 528, they're not considering it because their max was 500, right? They're just putting these mental barriers on themselves, and they're completely missing that what you want to do is try to get value for money, and you're not trying to just get a bargain or a property at a certain price. You're trying to get a quality asset that's likely to grow. And, sometimes you got to be a bit flexible with your brief, because you're always at the mercy of the market when you're buying. Like, we get clients coming in, and myself included, when I'm buying is, I'm going to go get this property and it's going to be on this street. I'm going to spend this price, and, this is what I want. Well, yeah, those properties exist. Does that mean they're going to sell in a reasonable time frame and they're actually going to come onto the market when you want to buy? Probably not. And what people have to do is be flexible. I didn't really want to be in this part of the suburb. I didn't really want to be on that road, or, I didn't really want to have that aspect, but you know what? That's actually a pretty good option in this market, and it's probably the best that's been on the market in 3 or 4 months. I'm going to have to make those compromises. And maybe it's actually a bit more than I wanted to spend, or maybe even a bit less, but it's better to buy now than wait and hope for this Goldilocks moment. Particularly when you miss out on that dream property that comes along, your anxiety goes through the roof, and you become a bit of a wounded bull in the marketplace, and agents absolutely love you because they know that you're, not moments away from probably a deal happening. So, that's just some of the behavioral science or the behavioral economics that go behind the property market. And, people can observe the property market from afar, but once you get in there and you go on a buying journey, that you lose control of your emotions. It happens to everyone. It happens to me. It would happen to you, Pete. You would have to admit there's been times in the past where you've acted emotionally because you're trying to get something
bias. Done. Yeah, we all suffer from it. Yeah. Loss aversion. Every study shows the same thing. We hate losing money at least twice as much as we enjoy the benefits of making money. I think I'm almost embarrassed to admit this, but when I used the first homeowners grant years ago in Bondi, there was a property that was listed at 540 and dropped to 500. These are old numbers, obviously, but the stamp duty exemption at the time was up to 500K, I think, from memory. And I was like, I'm just spending 500. I don't care. And I literally paid to the dollar. And it's like, I probably could have negotiated 497 or whatever. But it's just the way the anchoring bias works. There's loads of little cognitive biases like that, which impact almost everyone. It's very difficult to say, don't buy property emotionally. But that's how real estate works. People do buy real estate emotionally. And, if you like an area, it's probably likely that other people from your cohort would like it too. So, there's definitely a lot of that going on. In Brisbane at the moment, we're finding a lot of investors and home buyers around the same price point, 800 to 1 million. There's just so much competition there and a relative dearth of good quality stock. So if good stuff comes up, all the buyers agents will be there, all the upgraders will be there, all the home buyers. There's a lot of people around clustering around certain price points. And for units, 500-600. For houses, 800 to 1. It's thinner if you get further up the price points, but at certain levels, it's pretty tough. And there's definitely those biases that impact us, and auction bidding, negotiations. It happens to everybody.
Yeah, that clustering bias is, my budget's X. I'm going to go and get in the best place I can for that, and that's what everyone else is thinking. And then everyone with that budget is going to that area, and then no matter what the quality of the property is, they're all selling for the same price. And then there's one that's dramatically better, but it's 10, 15% above what everyone else in the market can afford. And, buyers, you go to those open homes, you think, God, this should be, going for a cracking price. And it's just that the buyers at that price point have gone to the other suburb, right? And you almost find this little, secret hidden gem sometimes in markets I've found over the years where you go, wow, if only I had an extra 200 grand more, I would have got 30% more land, better aspect, better street. But that buyer is actually in the next suburb. And so, yeah, you got to be really careful buying at the top of your budget and where everyone else is stretching to their budgets. Because, you generally don't get value for money in that situation. You're better off potentially going to the next suburb and getting a better property in the better part of the suburb with maybe a little bit less competition, but above where the other buyers can afford, and make that compromise rather than making a compromise to overpay for maybe not a best property. John McGrath made that actually in an article last year. I thought it was quite interesting, that point. And that's exactly what I've seen over the years as well.
Well, that's what Cameron Murray was talking about on an episode a week or two ago, is that the wealthier people get, the more they spend on housing. They don't really necessarily think too much more rationally than that. And that's why the amount that people spend on rent is fairly constant, really, as a share of their income over 10, 20, 40 years. So let's wrap up on those three news stories this week. So savage repricing for interest rates, US inflation figures, and actually also retail figures spooking the horses a little bit. In Australia, world leaders in interest rate pain, said the IMF. If you look at market pricing here, no cuts priced in until 2025. When we started the year, Australia's 3-year bond yield was about 3.6%. Today it's 3.95%, so definitely a move in that direction over recent weeks. And finally, wealthy property investors returning to the big city, reported CBA by the Australian James Kirby. So despite everything, the housing market has held up well. And I guess we're almost literally now in a bit of a holding pattern for the next 6 months. I don't think we'll see too many changes in interest rates, and be interesting to see how well the housing market holds up, Chris.
Yeah, I think budget 4 weeks away, right? Probably your favourite day of the year there, Pete. But since you see that's going to sneak up on us. And I think, what happens to interest rates over the next 6 to 12 months, I think it's been a mug's game, right? Picking that over the last few years. It was just they're staying zero for 10 plus 15 years. And now it's all of a sudden, where are they going? Where are they going? Up, down, etc. So I don't know. Who's know the bit of positive story comes through over the next few weeks and back on the agenda that rate cuts are in 2024. So nothing would surprise me with interest rates.
It's a sad state of affairs when your best nights of the year are budget night and election night. But I go to see the Lions play Geelong. So shout out to Stuart Williams, who's a Cats fan, I think. So hopefully this will actually go to air the morning after the game. It's an evening kickoff in Brisbane. So yeah, I'll go quiet on social media if they beat us. But it should be a good night. The kids always have a great time at the Gabba.
Yeah, I'm not mentioning Liverpool this week. Good to chat, Pete. And
the Palace.
Yeah, we look forward to having another conversation next week. Send your questions through. If you want to chat to Pete, go to the best blog in the country. I'm happy to follow it religiously if you haven't listened or followed that. And we're open for business. Link in the show notes if you want to chat around mortgage broking. So look forward to next week, and happy Sunday to everyone listening along, and send your questions through.
Cheers, Basie. Chat soon. See ya.
That's it. Bye.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.